Hello, guys. In this session, we'll be looking at double taxation. So, what is double taxation? So, this is the imposition of comparable taxes in two or more states on either the same income in respect of the same subject. Okay, so it is interesting to know that there are no rules of international laws that prohibit international double taxation. So, literally, double taxation is where one person is taxed twice by two different jurisdictions, or one income is taxed twice in the hands of two different people, either in the same or two different jurisdictions. Now, how does double taxation occur? So, when residents, be it individuals, corporations, or enterprises of any two given countries trade or transact commercially with each other, it gives rise to international trade or cross border transactions. And this may in turn lead to double taxation, where if a resident remits money to his country, he's being taxed but was also taxed in the country where he went to transact the business. So a typical scenario is when a person based in country A transacts business with a person resident in another country, say country B. The profit or gains that accrue to them, let's say if it's 100, this is likely to be subject to country A tax because he is a resident based in country A, as well as in country B because it was derived or sourced from country B. Thus, the same income item of 100 is subject to territorial double taxation once in country A, then again in country B. So, assuming country A has a tax rate of 30%, while country B also taxes the income at 25%, the person will potentially suffer a global tax of 55, meaning the 30 of the 100 and 25% on the 100, which will leave him with an after tax income of only $45. So, for instance, as we've talked about double taxation, there are some factors that connect the causation of double taxation or connecting factors that can lead to double taxation. Okay, so the taxability of a foreign entity in any country depends on whether it is doing business with that country or in that country. So there are two types of connecting factors that determine that jurisdiction we are talking about or that may lead to double taxation. So these are namely the residence and source principle. So this means that a person can be subject to tax either in its resident link or its source link with a country. So if a company is doing business with another country, that is the host or source country, then it will be subject to tax in its home country only, okay, based on its residence link. However, if a country is doing business in a host or source country, then besides being taxed in the home country based on its resident link, it will also be taxed in the host or source country based on its source link because the income was derived at source. So usually trading with a country says a lot. It tells you that okay, you don't have any physical presence in that country and hence you won't be taxed in that country. Okay, you only be taxed in your resident state. But when it comes to trading in a country, you have a physical presence in that country. So you are taxed by the source state and also taxed in your resident state. Okay, so these two factors conflict. The residence principle is where residents of a particular contracting state are taxed on their worldwide income. It's also known as the global source of or the global basis of taxation. While we have the source basis, and that is where we tax only income that accrue from that particular state or that is earned from a particular state or as a source in that state. Okay, so that is the source principle. It is also known as the territorial basis of taxation. Now, one thing you should know is that when the source and the residence principles overlap, remember they are the connecting factors, they lead to double taxation, as I was talking about. So, what are the causes of double taxation? So, the connecting factors of source and resident lead to conflict in tax systems or overlaps, which lead to double taxation. These conflicts may be resident source conflicts. So, this is where resident system of one overlaps with the source system of another state. So, if just like the example we saw above, if A goes to transact business in country B, he will be taxed in country A as a resident using the resident system, and he will be taxed in country B because the income was generated from that source. So there will be a resident source conflict. Then we have what we call a residence conflict where two resident systems overlap. Usually under the DTAs, this is where the tiebreaker rule might be involved. So both countries are saying that the person is resident. So let's say if I were to be a citizen of Ghana automatically, I'm resident, but I stayed in the UK for, let's say, 184 days. They also deem me as resident. Because of that, we can say that assuming there are no DTAs involved, this could lead to a resident conflict, okay, where it can lead to double taxation as well. So we have source to source conflict where two systems are claiming, or two countries are claiming, that that income was generated at source from their end. So let's say a worker who is stationed in Ghana and invoice a salary through his UK bank account. UK might say the income was generated at source from there, and Ghana would also say that since the worker was working here, the income is at source. So this could create a source to source conflict. Okay, so these are the sources or causes of double taxation. So they can ask you, some questions can say sources of double taxation. These are the sources of double taxation, and the causes of double taxation, you can use the same to define or describe the causes. So residence source conflict, residence resident conflict, and source source conflict. Okay, so what are the forms of double taxation that there are? There are two types of double taxation which you need to know about. The first is what we call the juridical double taxation. It says judicial, yes, juridical. And we have the economic double taxation. So the juridical double taxation is where the same income is being taxed twice in the hands of the same taxpayer in two different jurisdictions. So for example, where a dividend is being taxed in the country of source by way of withholding tax, and then none more time in the country of residence of the shareholder by way of assessment. Okay, so that is juridical double taxation. Or you could say that if I've generated income from UK, I was taxed in the UK at source, but I bring it to Ghana and I'm being taxed on that same income on a worldwide basis because I'm resident. Now, juridical double taxation can be broken further into three. We have what we call residence juridical double taxation. So this double taxation in this scenario occurs when a person is classified as a resident for tax purposes in two countries. So it is dealt with the tiebreaker rules mentioned at Article 4 of the UN and the OECD model. So these rules deem the person to be a resident of only one of the countries for the treaty. And for the application of the treaty by the two treaty countries, one country taxes the person on a source basis only with relief from double taxation being provided by the other country. As I was saying earlier, where there's a resident conflict and it's juridical, it leads to a resident juridical double taxation. So two states are claiming you are resident. Now, the next is a source residence juridical double taxation. And double taxation in this scenario usually occurs when an income is taxed at the country where it arises, that is the source state, and also the country in which the person deriving the income is resident, that is the resident state. So it is dealt with in various ways under the treaty by limiting the rights to either source or resident for some income or taxing the income in both treaty partner countries and resident countries to provide the tax credit or relief for tax paid in the source countries. The next is a source juridical double taxation. Now, for the source juridical double taxation, the double taxation occurs when an income is claimed to be sourced in more than one country. So, for instance, in the country from where the income arises and the country of residence of the person paying for it. So, such cases are commonly found for dividend, royalty, and interest, and tax treaties exclusively deal with the same. So, usually for source, some two countries claiming that the income has a source in their country, and we have to examine to see on a case by case basis. Usually, the tax authorities settle this by mutual agreement. So the next type is what we call economic double taxation. Okay, where the same income is being taxed twice in the hands of two different taxpayers. So continuing from the previous example we looked at, the profit earned by the company, which is the dividend paid, may be subject to corporate income tax. And economically, the corporate profits and the dividends are the same income. However, taxed in the hands of two different taxpayers. So it will be taxed at the corporate level and later taxed at the shareholder level as dividends. So that is economic double taxation. So be ready to deal with this double taxation, what it is, the connecting factors, the causes, and the types. Okay, so that is it. So why is double taxation harmful? One, it hampers the free flow of capital and it results in multiplicity of taxes. Also, double taxation can lead to detrimental international trade. Okay, it can also distort investment in a country. So there are a lot of disadvantages of double taxation. Now we'll come and examine them further as we go by. So in our next session, we are going to look at methods of relief from international double taxation.